Hi there, everybody. Welcome back to the Happy Meter podcast, an opportunity for two best friends to come together and discuss their guiding philosophy, the Happy Meter, finding a balance between your life's passions and joys and financial wellness. As always, I'm one of your co-hosts, Kevin, and I'm here with my very dear friend, Justin. Justin, how you doing, bud?
Kevin, how are we doing today? I'm hanging out here and trying to balance the work we're doing here and all the school stuff that's happening. We've got, we're now 2 weeks into professional development and really excited about school year coming up. Very strange school year.
Yeah, things are heating up for us too. And I got to say, with school being so close, one of the things I've had in my mind lately have been formative assessments. And, you made me take this quiz last episode, and I got to know, I got a 90. That's an A in my book. 9 out of 10. I'll take that every day of the week. That's on a roll right there. How did our listeners do? I know that you said a few people reached out to you. Did anybody beat me? I hope not.
I actually had a few dozen folks that reached out to me. I just want to shout out to Jason, who sent in. He either got a 90 or 100. I wasn't sure, but really close to you. I think he got hung up on the last question too. Shout out to Shannon. I believe she got an 80 or 90 coming in. Has been following us all along. We have two other guests, Tyler and Bethany, who I think to and from work, they share that they listen, and I believe they scored up in the top ranks as well. So pretty good scores all around. I don't think anyone beat you, though. I'm not sure. I didn't hear any hundreds.
I am thrilled to take that. And shout out to all those listeners who participated and who reached out to us and let us know how they did. I'm pleased that we're all doing so well.
That was a fun episode, I think. And I asked, my brother always follows our podcast, and I asked, hey, do you think that was a pretty solid recap of the previous season? And I think it hit a lot of the key points, and he did think so. So, and he would tell me otherwise. So I was excited to hear that. But I do want to jump in, because I think each episode we spent just a few seconds on, your personal journey through your finances. And we spoke last week a little bit about a few small changes we had to make in your portfolio. So why don't you share with the audience kind of what happened last week and what adjustments we had to make on the recently?
Sure. So as we've shared a little bit, with the summer, I was able to have an additional revenue stream come in as income, which allowed me to make some new changes to savings and investments and all that good stuff. But one of the things that you and I had been playing with was increasing my contribution to my work retirement account significantly. We're up to about 20%. Mm-hmm. And of course, that's going to change as things start to settle down a little bit, my actual biweekly take-home pay. And so I'm really grateful to have you as a financial advisor to talk to me about what we need to do and when we need to do it. Basically, by increasing my contributions to 20% there, which of course is still going to my retirement and helping me out as an investment.
Which doubled, because you were about 10.
Yeah, that's about double. But that's going to diminish my ability to invest in this other space, whether that was, stocks or whatever else. And so you and I are still kind of adjusting exactly how much take-home pay do I want, how much of that do I want going into these different investment accounts, and how much should really be going to that pre-tax work retirement account.
Right.
You know better about how to articulate this. I mean, and again, like I said, I'm so grateful to have you as my financial support person, because it's the kind of thing that is probably a little bit beyond my comprehension. Would you want to add any detail to that?
Yeah, a little bit to summarize. When we made your budget, like we do with what I recommend for all folks, is to create their budget so that we figure out what is the difference between how much money is coming in and coming out. And so we had a set amount for you. Let's just say it was $1,000 a month extra, right? We made a few decisions with that. Number one, we paid off your debt. Number two, we built up emergency fund. When that's done, we're now on that investment stage, and there's a lot of options that we can do. And that is really tailored towards each client's main goals, right? And so you're trying to balance two goals. You're trying to make sure you're planning for the future. That's retirement funds. That could be a Roth IRA, or that could be a 403B or 401k. You're also trying to balance, hey, right now, you don't have a house. Right now you're renting, and there might be a certain period of time down the road where you're going to want access to a larger sum of money. And so we can't put all our money in the retirement account, because for you, you've got to live over the next 20 years, and you're not going to be able to access that money. So we're trying to play that balancing act between making sure we have enough money going into long-term goals, short-term goals, and being really smart around taxes. So money that's going into retirement accounts does help us with a lot of tax efficiency. So we are constantly going back and forth on that balance. And what happened to you was we increased the 403B contribution, which means you had less money that was able to go towards your other accounts, and you saw your checking go down because we didn't make a change to your other accounts. And so when you started, I remember you emailing me, you were like, hey, Justin, my checking account's getting below where we want it. And I was like, oh, yes, of course it is, because we increased one while keeping the other the same. We might have to take a little small pause on this other account until we get your retirement account where we want it. So I mean, what a great problem to have.
It is truly a great problem. And I would just say for anyone out there who's either been in a similar situation or might find themselves there, it's such an important mindset to remember when you're investing in any of these categories, you're paying yourself first. So even though at first glance, I look at that checking and think, oh no, I have an automatic contribution to some other account, and I don't know if this is going to work out for me this month. Remember, you're still paying yourself first. And as long as you take care of those other steps Justin mentioned, like having an emergency fund, you're going to be okay. And that's one of the thrilling, nice things, is to be able to take a breath, realize that we're still doing good work for ourselves down the line. And it's never too late to pivot and figure out what the best strategy is. In keeping with that and how many different strategies there are for investment, the goal of today's episode, and really our main topic, is Investment 101. It's some basic information. This is stuff that I need too, so I'm looking forward to hearing from Justin about it. It's all the different kinds of investments that are available to any of us out there looking to get in the game. Before we actually start talking about investments, though, we want to make sure that we mention our disclaimer. So just in case anyone is wondering, we make no representation as to the accuracy, completeness, currentness, suitability, or validity of any information discussed. Remember that we are full-time teachers as well, especially me. I know extraordinarily little about all this stuff. I'm more just excited to learn from Justin as much as all of you. All information should be taken as two guys' opinions and should not be misconstrued as professional or legal advice. This is not an investment advice show. For advice on your unique situation, as I have done, seek out a qualified fee-only fiduciary financial planner. That is definitely the best route. Anything I missed there, Justin?
Got it. Got that out of the way. We have to do that. So yeah.
We're gonna do it. All right. So start us off, Justin. Investment 101.
Yeah. So again, today's topic, we're diving into kind of the minutia of investing. And so I want to just start before we get into the definitions and all of that. When we go through and we think about when can I start investing is when I always hear from folks. Let me just start with these are the steps. And we've gone through these like 4 or 5 episodes by now. One is we have to have a budget aligned to our goals, and we find a gap number. That's the difference between income and expenses, right? We spoke about that lots, Kev. Number 2, we pay off all our debts, okay? All of our high interest debts, like our credit card, our car debt, that's got to go. Do not start investing money till those are gone. I highly encourage us. We got to wipe those high interest debts. And the reason why is because the possible returns that you're going to get in the market, all right, might not even come close to equal to what you're paying in a credit card debt. For example, I typically see credit card debts between 10 to 30%. Very few years in the stock market do you see those returns. So I'd rather guaranteed pay off my 10, 20, 30% debt and then me possibly get a 10% return in the stock market. So we got to pay off the high interest debt first. So budget, pay off your debt. Number 3, you got to have an emergency fund ready. We don't want to be investing money without having an emergency fund. And here's why. Let's just say, Kevin, you have a car issue and your car blows up between here and school next week, right? You're on the side of the road, your engine goes, right? I don't want to sit here and have to go into your investment accounts that's invested in stock to have to pay off your car. So if we didn't have an emergency fund, you might have to sell stock when the market is down. So we never want to be in that situation. So we want to have that emergency fund built first. Then we can start investing. And investing should be towards certain goals. It might be a short-term purchase you have, like a house 5 years from now, Kev. It might be a long-term purchase down the road, like this dream vacation home you may have 10 years from now, 20 years from now. It could be you paying for your kid's college that was just born, so it could be 20 years from now, or it could be retirement. So budget, use that budget to be able to get to figure out your surplus amount that you can put towards your debt, pay off your debt, then get emergency fund in place. Do not start investing until those pieces are in play.
I love it. Sorry, and I'm just thinking about what a teacher you are. I always tell my students that when a teacher repeats an essential point more than once, it means it's extraordinarily important. It's going to be on the test. And like you said, we've gone through this in a couple episodes episodes. You did it a couple times. For everyone out there, budget, pay off your debt, get that emergency fund, and only then invest for goals.
Yep. So investing, guys, investing is, bottom line, it's the process of laying out money now to receive more money in the future. It's how Warren Buffett, who's the legendary investor, shares. So the process of laying out money now to hopefully receive more money in the future. Kevin, can you think of any examples out there besides stocks, which is really common? Any other investments that kind of come to mind?
Sure. I mean, you already mentioned like home and maybe dream vacation home one day. So I guess like property or real estate is
Yep.
one that I know a lot of families build their intergenerational wealth on. I would argue that education, I mean, it is an expense, but like, even if you think about our certifications as teachers, by getting that education, hopefully that opens us up to new opportunities to make more money or advance or what have you. So yeah, those are two.
I think that's a great one. Actually, education and health to me are actually some of the most important investments that you can make. You're laying out money now, and hopefully later on you have a happier life. You have more choice around your life. Hopefully, putting more money in education now could possibly yield you, more income later in life. So you're putting money into a, college now to be able to get more possibly later on. Doesn't always work out that way, like any investment, but hopefully that's what happens. Some other ones, we have bonds out there, which I'm going to talk about today. Also, some families are big into collecting collectibles, right? There's a lot of folks out there that, might buy and sell baseball cards or basketball cards or jewelry. So those are all types of investments out there. Again, the whole idea is that we lay out money now, okay? Invest money now, so hopefully we receive something in the future. Today, we're going to focus on the two big ones, which are bonds and stocks. That's mostly the work that I do with clients and what I find that I think I'm most knowledgeable in. So we're going to share about those today. So let's just start with cash. When you have cash, that literally is that piece of paper that you go buy things with, right? So with cash, you can take it, you can put it in your bank account, and you can also put it on your mattress. But the bottom line with cash is that it's going there, it's sitting there, and it's not gaining value, right? Any examples of that, Kev, you want to jump on with?
Well, just that phrase under the mattress, I think it's like a Great Depression image, right? Yeah. It's this notion that at a time when people couldn't really trust the banks, they weren't federally insured, that they might take their cash because of their fear of it being lost suddenly in a collapse, and literally just putting it under their bed. So I guess it is literally what you have. It is tangible, it's liquid, you can use it, but it's not going to grow, it's not going to do anything. It just is itself right there.
Right. And I wouldn't call that investment. You're literally just trying to stockpile some cash, right? Now, there are a lot of folks out there who are afraid of investing in different items, and they keep cash and lots of cash, and that's how they save. And if you're not comfortable with bonds and stocks, that's okay for you to keep cash, and that could be your retirement, but you're going to have to work a lot harder than most folks that are putting their money in the market, right? Yeah. So cash is great for short-term things. Cash is wonderful for an emergency fund. Cash is wonderful if you're going to go buy a car in 3 months. We don't want to invest money for 3, 4, 5 months from now. So cash is a great thing that's for stable, for small things, for things you need in the really short term or emergency funds. Beyond that, though, if you leave too much cash, you're wasting a lot of opportunity where your money could build and work for you. So the next investment piece to share out, which are bonds. So bonds are when you lend money. I mean, at the most basic thing, you can remember, I'm sure your brother at some point in your time, Kevin, growing up, he might have, or you might have borrowed money from each other. All right. So it could have been, hey, here's $20 for, this toy that you wanted. Why don't you pay me back later on? Right. That is its own form of bond, except a bond typically comes with you lending money, but that they promise some type of return. So, and that's usually in the form of interest. So this might be for your brother. It might be like, hey, I'll lend you $100 on the stipulation that you give me $100 back plus an interest of, let's say, 2 or 5%. So it's like an extra fee that you're collecting by you lending your money to somebody. And there are numerous ways for you to be able to buy bonds. You can buy government bonds. You can buy U.S. Treasury bonds, right? That's literally you lending money to the U.S. government. You can buy municipal bonds. And that is when you typically lend money to the state for schools, for bridges, for highways, and they promise you that money plus extra in return. And then another type of bond you see out there is corporate bonds. And this is when businesses when you lend money to businesses and they promise a certain amount back in return of an interest rate. So we have cash and we have bonds.
Yeah, and the image for me of bonds is when you're little and your grandparent for your birthday gives you like a $10 savings bond or something like that that vests, in some crazy long amount of time for only $10. And when you're little, you think, oh, I can't wait to have this $10. And then when you're 25, you realize, wow, thanks, Grandma. I really appreciate this $10 from 25 years ago. Would you say bonds are like particularly stable? Is that part of the notion, or that because it's a lower interest rate that it's safer, that sort of thing? Is that how we should think about it?
Yeah, great question. So between those three bonds, government, municipal, and corporate, there are risky bonds in that mix. There are also very stable bonds. However, if you compare bonds to stocks, and if you think about a whole collection of them, bonds are much more less volatile. So bonds might be great in more of a midterm type situation. So an example of that might be for example, my dad is retired right now. We don't want to have all of his money in the stock market because he can't stomach or has the years to withstand a massive ups and downs that the stock market might have. So he has quite a few bonds in his portfolio so that his portfolio doesn't quite move at the volatile measures that a fully stock portfolio would move. So it is a little, depending on which bonds you choose, they're typically a less volatile than what you're sharing with stocks. That's a great, yeah. Okay, then the last and the big final one that most people talk about, they're stocks. So stock is when you own shares in a company. So for example, if you were to buy a share of Apple, a $2 trillion company right now, okay, you could give $100 to Apple and they can give you a small, teeny little fraction of their company. And they can share profits with you and also dividends with you. So let me break down what those are. So a dividend is when a company shares some of its profits with the shareholder. And the other way to increase money in a stock is when the value of the stock increases. So the share price goes up. So stocks really have two ways that you can make money. It's a dividend, which is a payout that the company makes to share some of their profits with shareholders. Or two, it's when the share actually increases in value over time. So stocks is when you own, bonds is when you lend, and cash literally is just cash. You want to break down it all and stocks for us at all, Kev?
I guess I can try. You mentioned earlier when we were talking about investments, how some families are collectors of things. And I think a lot of us growing up collected things at different times. Let's just say, for instance, baseball cards.
Yep.
So that baseball card might have a value, and it might even increase because it's rare or it's sought after in some way. And so that is very similar to a stock in that it's something you own. It's kind of like a symbol more than anything else. Mm-hmm. One difference is that the stock market is constantly being reevaluated, like what are the values of these things. But when you sell that Cal Ripken Jr., shout out Orioles rookie card, you've made it real. And it's no longer just a perceived value. Once you sell it, you actually have the money that you thought it was valued at. And same with a stock. As long as you own it, you don't actually have money for it or something, right? But you do have a sense of what it would be valued if you sold it.
Right.
So in both cases, it's an investment where you own, I suppose like a property or more like a symbol of something. But when you cash out, you hope that the value has gone up over time.
Right. Love it. See, thank God for you, Kevin. Thank God.
I'm picking up what you're laying down.
It's all up in my brain, and I need you to just clarify it for folks. So thank you so much. So another big piece to this that are three vocabulary words that I always get asked about. One is a mutual fund versus an index fund versus a bond fund. So I want to break that down. So a mutual fund is literally a basket of individual stocks all in one. So think about it. You're out there picking apples, right? You could pick this apple, this apple, this apple, this apple. All of those are individual stocks. You can own those separately, or you can own one fund that has a lot of those apples in one basket. Now you can imagine there's a lot of good to that. Right? Think about the good of having a variety of different apples in that bin, right? Some of those apples may be beautifully and wonderfully ripe, and they may be very, very fruitful for you. Some of those apples, they may not be great. And so when you have a basket of all of them, it diversifies your portfolio so that if you happen to pick one individual stock that's not great, it doesn't kill you. So a mutual fund is a basket of stocks. An index fund is still a mutual fund. It's a basket of stock, but it's tracked by an index. So the most common index that you probably hear on TV most days is the S&P 500. So that's the top 500 weighted cap stocks in the US. So when you own an index fund of the S&P 500, you're literally buying the 500 best stocks in the country at that time, and they're weighted. So you can buy a mutual fund, which is somebody selects those stocks for you in a basket, or you can buy an index fund, which is when pretty much like a computer selects the top 500 stocks in the country, and you own a basket of those. And then a bond fund is the same thing. You can own an individual bond, or you can own a basket of bonds. So instead of just owning one US government bond, one European Union bond, one Baltimore City, they're building a bridge, a bond for those, a bond fund owns a collection of those. So again, it spreads out the risk. So there's good and bad to owning individual versus not. I'm a big fan of owning baskets of stock because I'm not great at picking individual stock. And statistics show not many people out there are. So owning a big basket of them, to me, limits risk. You're not going to be rich overnight, right? I'm not picking the Apple. I'm not picking the Google. I'm picking a whole collection of them. And as a group, I'm hoping they continue to increase in value over time.
Yeah, to help us wrap our minds around this, could we contextualize this with actual money figures or percentages of growth or something?
Sure.
I understand the academic side of it and certainly the clarity of your advice, but could you kind of prove it with some real financial numbers?
Yep. So let's start with cash, Kevin. If you owned 10 years ago, if you had $1, today, because of inflation, which is the value of that dollar going down in value over time, that dollar would be worth 84 cents today. So if you kept your $1 in your mattress 10 years ago, you took that dollar out to go spend it now, that dollar would be technically worth 84 cents today. Is that a good investment?
No, sir.
No.
That's a bad investment.
But
it's not an investment.
But wonderful to keep for something you need in the short term, an emergency fund. Like I don't want ups and downs. So keeping cash is great for that case. Now let's jump into bonds. If you look at a bond fund, and I'm going to use the Vanguard Total Bond Fund. It's a very common, very popular bond fund out there. If you invested in that 10 years ago, okay, you would have seen 45% growth, which is about 3 to 4% each year on average. So I want to be clear what that would look like. 10 years ago, you put $10,000 in that fund, it'd be worth about $15,000 today. So you would have made about $5,000. Now let me go through the swings of what each year produced. In 2006, that would have produced 4%. 2007, 7%. During the crash, 8%. During 2009, 6%, 6%, 7%, 4%, negative 2%, 5%, 2%, 3%. So you can see those numbers are all pretty steady, somewhere between -1 and +5. So the volatility of owning bonds is not too large. Might go up a little, might go down a little, but pretty steady. That's the smooth ship in your portfolio. Now let's look at what a stock index fund or mutual fund would look like. So I'm going to look at the Vanguard S&P 500 fund, which is, again, one of the most popular funds out there. So this, if you own that, for the last 10 years, you would have saw 265% growth. So to put in that perspective, the bond was 45%. The last 10 years in the S&P, you would have made 265% growth over that time, and you would have moved each year on average 13.9%. Again, the bond was 3.84. The S&P over 10 years was 13.9. If you invested $10,000 10 years ago, the bond would have been 15, we just shared. The stock market, that 10% would have returned up to 35,000. So you would have made 25,000 in the market during that time. Now, during that time though, look into these numbers, Kev. In 2006, you would have made 15%. 2007, you would have made 5%. Then we had the crash of 2008. You would have lost 36% that year. In 2009, it went back up to 26, then 15, then 2, then 15, then 32, then 13, then 1, then 11, then 21, then -4. Last year was 31. Tell me what you hear about those numbers, Kev, compared to the bonds.
Well, I'm definitely seeing a lot more swing. I mean, even the 2006 good year was 15.75. Then 2007 still growing, but it dropped all the way down to 5%. So that's a more significant shift than I think we see really at all with bonds. And then to see that we got the 2008 crash negative, basically 37%. You don't see those swings at all, but over a long enough period of time, you're right. I mean, the numbers don't lie. You'd get more than double the growth if you were with the S&P 500.
So if we were to kind of conclude the importance of what we can take away from this, Kev, if we want anything in the short term, emergency funds, anything within the next 6 months, we want that to be in cash. I don't want that in anything. I don't want even to go down 1% in the bonds. Okay. Anything we need in the short term, we want some type of bonds mixed in there. So we want to increase a little bit of growth. All right. And anything for the long term, would it make sense for us to sit that in cash?
No, definitely.
You would have lost money. Would it make sense to only keep all that money in bonds? No. You would have missed out on tons of growth. So for you, Kevin, who's 31, who's going to retire around, between 55 and 65, where would most of your money make sense for retirement?
Definitely in stocks, S&P 500, all that kind of stuff.
As long
I want
as
every one of my dollars.
Yep. And as long as you can stomach it and you understand that your money is going to go on a wild ride, because we don't want anybody jumping ship, because that's how you lose money. But you got to know when you put money into your retirement account, this is for 30 years from now. It will go up and down so often. In your investing career, you will see a 2008 happen. You will see lots and lots of swings. Just COVID happened in March. Your value would have lost 30%. So you are going to have swings. So any money that you're dedicating to long-term growth, you need to know it is the best place for you to be, but you got to be able to stomach it. So in conclusion, more stock equals more volatility. More cash, less volatility. So Kev, I got a quick game for you here. And this game is called Choose the Correct Allocation.
Okay.
So you're going to tell me, I'm going to give you about 6 scenarios.
Okay.
And this is what you're going to tell me. Are you going to tell me, is this person, should they have this account in mostly cash, A, B, some stocks, some bonds, or C, mostly stock?
Okay.
Let's start with the first one.
And I want to tell our listeners that you shared with me that this would happen, that you were going to quiz me today, but I'm actually doing this right now. I don't have the answers. So I'm, again, just like last week, I'm a little on edge. I want to make sure I do well. So here I go, hoping to make you proud. Here we go, coach.
All right, we ready? Short-term emergency fund. Should it be A, mostly cash, B, some stocks, some bonds, or C, mostly stock?
Short-term emergency fund should absolutely be mostly cash.
Yep.
Because we want to be able to grab it like my car. You said whenever that old thing breaks down, I need money right close to the hand.
Right. Why would we want to put that into a market swing? We want that money immediately. And that usually, if you remember way back to, I think episode 2 or 3, your emergency fund is money for 3 to 6 months worth of expenses, just in case you lose your job, your roof goes out in your house. We've had some friends that happen to, huh, Kev?
Yep.
Car breaks down, which sadly for you and I, that's happened a few times as well. Like we need money to go to, and we don't want to sit here and have to trade bonds and stocks to be able to get that money.
Yes.
Okay. Number 2, long-term retirement for a 30-year-old.
So just did that. I know that between the 3 options, that should be mostly stock. If you have the ability to stomach the swings, we want to see long-term growth, even though a year-to-year swing might be kind of wild. Over time, we want to be making money, putting our money to work for us.
Great. Number 3, a house purchase in 5 years.
5 years feels a little close,
Mm-hmm.
but it's not like mostly cash level close. I think that might be one where we go some stock, some bond, that B option. It's a little bit more stable, but we'll still have hopefully some growth.
Right.
But this is one I'm not sure about.
Yeah, absolutely correct. We definitely want some stocks in that portfolio because we want some growth out of that, but we don't want to put 100% stocks there. So what I would do with a client for that is we would fill out a risk tolerance survey. I would interview them about their time horizon that they need this money, the risk tolerance that they'd be able to stomach, what their employment might look like over those next 5 years. And we'd make the decision on what percent would be stocks versus bonds. But I would tell you there would be probably some of both in that mix. So
Gotcha.
Somewhere like 30, 40, 50% stock, 30, 40, 50% bonds. And it would be a mix around there.
So to be clear, I got it right so far. 3 out of 3.
3. Okay. Next one. What about if you were to just have a newborn? So just have a newborn and you're trying to save or want to invest for their college 18 years later.
18 years is still a long time. It's not the 30-year outlook of retirement, but I would think that we'd still want that in mostly stock.
Yeah.
Yeah.
4 for 4, Kevin. 4 for 4. Absolutely.
Let's
That's a
go.
long-term horizon. Really, anything after 10 years, I'm looking for pretty much to be fully stocked. I want those gains. I'm willing to stomach. Like, I don't care when the portfolio at 5 or 6 years old that my son or daughter's portfolio drops 30, 40%. It doesn't matter to me because I don't need it until 18. And so that actually gives me an opportunity to buy at a lower price. And so I would 100% be, again, based on the client and their risk tolerance, I would be more heavily aligned to the stocks for sure on that one. Next one, Kev, what about this one? What about a car you might need in 2 years?
So this is my situation, almost certainly. I feel like the goal would be that if you had enough of an outlook in advance, that you would have the cash on hand. That, because 2 years, especially with a car, it's like within 2 years, but you know that it could be tomorrow and it could be 2 years. I'm going to say mostly cash, that you want like an emergency fund that's built up enough to handle at least a down payment. But I do feel like hypothetically, you might advise that someone open a new some stock, some bond account if it's more like 2 years around that. But it's definitely not stock. I think that's an area where you would have the conversation about what's your comfortability. I'm going to say mostly cash, though.
Yep. Again, this is one of those where based on the person, everyone's different. There's no golden rule for this because you got to be able to stomach it. And everybody's emotional intelligence in investing is different. I would probably, again, similar to what we've worked on, Kevin, is your emergency fund needs to be able to handle if your car was to break down tomorrow. So I'm not preparing for that. What I'm preparing for is you tell me, hey, I actually want to buy a new car or I want to buy a used car. Don't buy a new car, everybody. Buy a used car 2-3 years from now that we can actually plan for. I would definitely put some of that money in bonds at that point. Okay? And maybe even a 10 to 20% stock there. Yeah. But I would definitely not be 100% stock. I wouldn't be over 50% stock for that portfolio. All right, Kev, another tough one. Last one for this one. Retiring in 5 years. So let's just picture this. You got $500,000 saved up. You've been working your tail off for 30 years. Okay. Got $500,000 retiring in 5 years. Tough thing. What do you think you do?
I would hope that I have a diversity, you remember diversity being so important, of different accounts and access points for money. And so I think that I would still want some stock, some bond. Like, I think that we'd take our foot off the gas a little bit if we're that close to retiring from like just the crazy stock swings. So I think that we'd bring it down a little bit to some stocks, some bonds. But with 5 years left of working every day and making a salary, I wouldn't be ready to go all cash.
Again, I think you nailed it. And again, this is really important based on the person's situation. For example, if this was a teacher who's got a pension coming in, right? They might not need a lot of this money that they have in their 401k or their 403b. So for that investor, based on what they can stomach, I might be more aggressive with stock because they may not need that money. Even though they're retiring in 5 years, they may not need a lot of that. Versus somebody who's retiring who has to live on this, then in that case, we definitely need to be a little bit smarter with making sure that the volatility is not quite as strong. So I would probably be somewhere in the middle there of stocks and bonds based on the person. I would definitely not be all cash, and I probably wouldn't be all stock unless their pension is going to cover everything that they need in their normal day-to-day life at that point. Kevin, you did great. I think that's 5 for 5.
Feels good. Hopefully some of our listeners did well too. And I'm curious if anyone would disagree with me, because again, we all have different levels of comfortability with, risk and all that sort of thing.
Kevin, and I think that's the most important thing I want everyone to understand out there. There are, of course, rules and what investment advisors would suggest and advise here. But it literally comes down to nothing matters if you can't stomach market turns going up and down, right? What the worst thing that can happen is let's say you're a perfect candidate for, you're 30 years old, you're investing in retirement, all right? But you're super scared of investing and 2008 happens tomorrow and you pull all of your money out. That literally defeats everything we're trying to do at this period of time. And if that is going to happen, we chose the wrong allocation for you. So even though you might be the perfect person for allocation to be 100% stock, if you can't stomach the turns and are going to pull out during downturns, we are way too up and down for you. Even though the numbers would make sense for you to be, and you'd make more returns in the long run probably being in all stock, it may not be what's best for you. Because the most important thing is we make a plan based on your allocation, and you have to stick with it through ups and downs. And I will tell you, Kevin, there is going to be a 2008 that happens over the next 30 years of your investing career. You are going to have to stomach your portfolio. which by then may be really large. Could be tomorrow, but it could be 20 years from now when your portfolio is massive, right? And you've got to be able to stomach that and feel right about what we're doing. And so this is so individualized. And you either got to study this stuff and make sure you're going to be able to stomach this, or you got to hire someone to make sure that they keep you in line during these times.
Absolutely. Seeing, Justin, that we're coming down to the end of our episode together, I know that one of the things we want to make sure we did was share some top questions that you've received from clients, friends, even some of our listeners about investing. So I think I'm going to pose them to you quickly and see how you would respond to each one.
It's like
and
a hot
hopefully
seat. All right.
Yeah. No, I'm giving it right back to you after that pop quiz. All right. So question number one, how do I choose what individual stock to pick?
So I am a big fan of not owning individual stocks. You know, if you ever see me play darts, Kevin, I'm not great at picking actual numbers. I can hit the board, but I can't hit that individual number. And then to do that every single year over and over and over again, think about playing darts. Every throw, you're trying to hit 20, 20, 20, 20. You're telling me you're going to be that good to hit that for 10, 15, 25 years? It's the same thing in stocks, right? I am not going to pick the next Amazon. I'm not going to pick the next Google. I'm not going to even try. What I'm going to try to do is own a big basket of companies that I believe in. And I believe that 30 years from now, because the American ingenuity that's happening all over the country, I believe our country is going to be stronger 30 years from now than it is today. So I'm a big fan of investing in large mutual funds or index funds where I don't have to guess and estimate what stock's going to do better than this one. If you are out there and an individual stock picker, I don't advise it, but if you are, just keep a small percent of your net worth in there. How'd that go, Kev?
Question number two for some of our more risk-averse investors. Why would I even risk owning stock? I need to protect my money.
So, Kev, I think if we go back to our chart there, if you owned just dollars and didn't invest in bonds or stocks, what happened to your dollar?
Oh, it went down.
Yeah. So you're going to have to work pretty hard to be able to earn enough. And we spoke like $1 million, $1.5 million you might need to be able to retire someday. If you have to do that all on your own with no compound interest helping you, it's going to be a pretty hard ride for you. You're going to have to work a lot. So for me, if you look at those historical returns, I want my long-term growth money to be in the stock market. I believe 30 years from now, the stock market will be much higher than it has been over what it is now. So I want my money to be in areas where it's going to grow over time. And so I think not investing it is more risky because you're losing money every single year anyway.
Yeah. This third one, we all know this guy who says this kind of a thing. And I'm sure you as a financial person, you probably hear it even more than most. So what do you say to the guy who comes up to you and says, I heard about an amazing new company. It's always better to get it on the ground floor. Imagine if you own day one stock in Apple, Facebook, or Google. How much should I invest?
So I'm a big fan of avoiding all investment fads. You know, I guarantee there was an investment advisor that somebody came and shared with them, hey, let's go buy Radio Shack. It's the new IPO of the time. I bet you some investment advisor at one point heard from one of their clients, hey, Kodak's coming out, right? Way back when, even though Kodak is spiked right now because they switched. Anyway, long story there. But anyway, we've heard fad after fad after fad, year after year after year. I'm not interested in playing fads. And if you are out there, please keep it to a low percent of your net worth. Keep it to some fun money. This is not your retirement money. This is 5% of play money if you have it out there. For me, I'd rather take this historical returns of 7 to 10% in the S&P 500. I'm a really boring, non-sexy type investor. I like to put over and over and over again in index funds and mutual funds. I'm not interested in going into fads. It's a waste of thought process for me. It has shown no historical evidence that beating just doing over and over again boring investing into mutual funds.
Yeah. I'm reminded of the old expression or the old adage that the fool and his money were soon parted. And all of these get rich quick investment stuff, I think it often reveals, you know, our eagerness, but that maybe too often we are fools and we should stick with what our fiduciary advisors tell us and just invest carefully.
Yep.
Last question, Justin. Isn't the market doing too well right now? Shouldn't I wait for it to come down and be a little cheaper before I invest? I don't want to buy high and then lose money.
So there's actually a chart out there, Kevin, which I'll show you at some point, and it has all the peaks for the last 100 years that the S&P 500 or the stock market's, you know, been going on here in the US. So if you look at the last 90 years, there's been like hundreds of peaks. And in every period one of those, I guarantee that somebody out there or hundreds of people out there said, is this the up? Is this the top? Is this the peak? I'm sure it was said in 2000, in 1940s and the 50s and the 80s. It was said definitely in 2005. It was always said, but we've always continued to climb. Now that doesn't mean it may not drop tomorrow. Doesn't mean it may not drop next year. But if you look at the historical returns of the United States, the S&P 500, right? I am a strong believer 30 years from now, it's going to be higher than even right now, even though we're at a peak and we just hit a new high today. So I'm a big fan of not timing the market. I'm a big fan of consistency, and we play what we can actually control, which is our savings rate, the fund we chose, and we do it over and over and over again for 10, 20, 30 years. And nothing sexy about this approach, Kev. I use sexy twice in one episode.
Well, I think it fits with the happy meter, ethos. To wrap us out here, Justin, what are some key strategies that you would want to make sure every listener has at least heard from you that you think are just best practices? Take it away.
Number one, automate, and never time the market. And what I mean by that is you set up every single paycheck or every month or every week the same automatic contribution, and you make that based on the gap between your income and expenses, and you automate it over and over again. So you literally pay yourself. Just like the credit card companies send you a bill every month, just like the car company automates when you take money and send them there. This is the same thing, except you're paying yourself. So automate. Don't worry about what the market's doing, and do it over and over and over and over again. And you will be very wealthy 30 years from now. Number two, don't put money in the stock market that you need for the short term. We talked about that and why. Like, I don't want to be volatile. I don't want my money to be volatile. I have any money I need in the short term. Mm-hmm. Number three, during market downturns, turn the TV off, turn CNBC off. Okay. When the market's going to tell you the world's going to crash, they've been saying that. They said that in March when COVID happened. They said that in 2008, right? They said that in 2001, and all of these market crashes that the world was going to end. Pull your money out. No. Grab a glass of wine, chill out. You're going to be fine 10 years from now. As long as you pick the right allocation, you don't need that money anyway right now. So when the market goes down, stay the course, keep buying and chill.
Gotta ride the waves.
Yeah, right. Number four, only individual stock trade with a small percent of your net worth or none of it. Don't gamble and sit here and try to play darts with individual stocks unless it's a very small amount. That's not going to make that big of a difference in your future. Okay. And then number five, either have a trusted advisor or coach, or study your butt off and write down a plan, and I call it an investor summary profile, that when the market goes down, you are going to stay the course. It's the number one mistake that happens to folks out there. The market goes down, their parents, the TV, somebody tells you to pull all your money out of there, and then you pull out at the bottom, and then all of a sudden the market rebounds, and you're like, oh, when do I go back in? Ride the wave. You don't need any of that long-term money in the short term. So, hire someone that's going to coach you through that, or you really need to study and know yourself to make sure you're not going to be pulling out in the downturns. So in conclusion, good investing is not get rich quick schemes. It's not sexy. It's boring. You got to be consistent. You got to do the same thing over and over and over again, month after month. And emotional intelligence is the number one predictor of a good investor or not.
I love it, Justin. We learned so much today. Thank you so much for taking the time to break it all down for us. We now know cash, we know bonds, we know stocks, we know investing. And as always, we know those basic first steps. Make a budget, pay off your debt, and only then do you consider doing any of this kind of investment to start building your wealth so you can meet your goals. Justin, any last words you want to share?
Nope, that's it. But I'm really excited about our next episode, which is a walk in the Redwoods National Forest with Justin, and where I've used nature and trees to be able to teach us a little bit more about the investment strategy that I spoke about today. So pretty excited about it, and that'll be coming out in a few weeks.
Heck yeah. You know I love a good metaphor, Justin. Can't wait to talk to you about it. Everyone, thanks for tuning in. Hope you enjoyed. Hope you learned. Good luck investing. Keep that balance in your happy meter. See you next time.